For the US, not everything is pulling in the right direction. The Fed will be keeping a close eye on wage growth for now. Ryan Littlestone, Forex Live. Well, a euro area slowdown puts the emphasis on Germany once again as Brexit risks gather pace. What then is your assessment of the Eurozone's economic situation?
Yeah, we've had calls that the second half of the year was potentially going to slow anyway. So it's obviously a bit of an improvement that we've got from Germany there, which may allay some of those fears. The Eurozone GDP, the second estimate came out more or less the same as the flash back at the end of July. So overall, you've got to look at the economy and think, it's not going all guns, but it's not exactly collapsing, and things are still pretty slow, pretty sluggish, but they're on the right side of the negative line, if you like. But it's still early days as far as the Brexit situation goes. There's a lot of water to go under the bridge. So it all depends how the data rolls out over the next quarter, I suppose, and we'll get a better idea of that. And if growth holds up, then the Brexit fears are going to be allayed and going to lessen, and perhaps Europe can then bounce a bit further towards the end of the year.
Okay, well, according to a report by the Atlanta Fed, the US economy is on track to grow at 3.7% in the third quarter, and there are expectations, increasingly, of an interest rate hike sooner rather than later. What is your view of US economic sentiment?
The economy itself, it's something we've been talking about on the site. It's not everything is putting in the same direction. We've got excellent jobs data, very, very strong jobs data. There's not been a negative non-farm payrolls number for something like nearly 6 years now, and that's never happened in the series at all. We've had a couple of wobbles over the last recent months, but then the last 2 months they bounced back very strongly. What the Fed's waiting for now is the wages to really pick up, to really get ahead of steam, and that will strengthen the consumer side. We're going to see that again today. We've got some sentiment numbers and obviously retail sales. And if you look at the sentiment, you've got to ask what's wrong in the US, because the sentiment numbers are running at very high levels, but that's just not translating into equally strong retail sales.
And lastly, a year ago this week, Chinese authorities stunned global markets by devaluing their yuan currency, stoking fears that things were much worse than many had realized. To what extent would you argue this to be justified?
Yeah, I'm not sure that investors are that eased. What we've been noticing recently in bond markets, just globally, if you look at the wider picture, is there's a lot of running around looking for yield again. We're seeing bond prices, bond yields fall as this is across the world. So with regards to China, okay, they had that big blowout last year, but it's no way near the end of the road. If you take their basket, it's been sliding, I think, since the beginning of the year at something like 12-15%. And again, that's happened even more so since Brexit. So it's six of one, half dozen the other what the Chinese are doing, and we never know what they're doing. So if you had to pick a side, you would hope that they're doing it for the right reasons, that they're just getting control of their economy, getting control of all these supposedly bad finances and debts over there, and that it's going to be better in the long run. But if we start hearing problems that they're doing that because there's trouble brewing, then that's going to scare the market once again.
Thank you, Ryan. Be sure to check back on Monday for the week ahead with me, Sam Meredith. Goodbye for now.